Okay, so high unemployment, slowing economic growth, some weak third quarter earnings, all of this casting a dark shadow over the year's market rally. Risks of a bear market have some investors pulling out of stocks and pretty much taking their profits. But we've got somebody who says do not run screaming just yet. He's got 3 ways to play a market implosion and shield your portfolio. Joining us now, Jeff Reeves, InvestorPlace.com editor. You always come up with interesting story ideas, and we wanted to bring you on because there are people who feel, and many of them out there are very concerned about a very cloudy outlook. So you say there are 3 different ways to actually keep the powder dry and hide it in a little money cave. How do you think that we're going to have a market implosion? What would get us there?
Well, I wouldn't necessarily call it a market implosion. I mean, I do think that the fundamentals of the economy, to borrow a political phrase on debate day, is that they're a lot better than they were, 4 years ago. There are still troubles, though. I mean, I don't have to rattle off the list. China slowed down. There's Europe. There's the fiscal cliff. I mean, everybody knows the score. So I think a 15% rally year to date in the markets. We've seen a little bit of a contraction lately. I think it's because people are a little worried. They're tempering their enthusiasm. So I think it's just prudent to be responsible long term. I mean, I'm bullish in the long term, but I don't advocate ever timing the market. So if you want to get defensive in the near term, this is a good way to kind of protect your money but still get in there for growth if there is the potential for a big rally again.
So a couple of bricks might start falling from this wall of worry, and we say bricks falling because it's really been built up as the markets have done quite well, held up, very resilient. Today's a perfect example where we fought back from a 100-point deficit in the last hour to simply move to the upside here for the Dow Jones Industrials, S&P, and the NASDAQ looked better. But let's talk about 3 places you feel are appropriate to hide the cash for the time being if you do want to get defensive.
Yeah, I mean, I come on with you guys and I talk a lot about healthcare stocks. I mean, I think everyone should have an overweight position in healthcare in their portfolio just because it's very stable. It's defensive in nature. You look at the baby boom. As these people get older, they need more care. It's human nature. You age, your body breaks down, people get sick. There's baseline demand there. It's a very growing sector of the market. It's a good place to put your money. 2 big stocks that I like right now are Eli Lilly and Merck. Lilly just came up with a potential Alzheimer's treatment, which has shown a lot of potential earlier this year in some trials. And Merck has a brittle bone drug. These are both really good baby boomer investment type of plays. And if you don't like to play individual picks like these, I like both of those stocks. They're up decent year to date with decent dividends. But if you don't like the individual healthcare picks like that, there are ways to play it with funds. I like the IYH iShares ETF. It's got these big pharma stocks in there, but also the insurer UNH. It's got medical device companies like Intuitive Surgical. So if you want to cast a wide net on healthcare, you can do the fund route. But I like Eli Lilly and Merck among big pharma right now.
Well, I find it fascinating where you said these are good boomer plays. All pharmaceutical companies have different skews. Some of them are very broad-based, but to look at those 2 and say they play on an aging population that is now living a lot longer. So those are the 2 names you like there. We also showed consumer names, and there's some concern that consumer names might get hurt. But again, everybody still eats and drinks, do they not?
Yeah, exactly. These are necessities, not luxuries. I mean, even if we do see a downturn, if there is another double dip or whatever you want to call it, I mean, you got to get out of bed in the morning, put your kids in diapers, you eat breakfast. I mean, you use shampoo, Liz. I mean, I don't really need shampoo. My shampoo budget is pretty low. But, I mean, everybody has. That's why they're called staples. I mean, these are things that we use every day.
And everybody's mainlining Diet Coke around here. That's for sure. I mean,
Yeah, and the 2 companies that I really like are General Mills and Coke right now because while there is stability in these consumer plays, baseline demand, you also got to consider that some of these companies are very well run and have actually seen outsized growth. General Mills and Coke are both up 30% in the last 5 years, and they're up 50% when you put the dividends in there. Both have a roughly 3% dividend yield. So it's not like you can't get growth in these stocks. A 10% annualized return in both of these stocks when you include their dividend is pretty impressive. So I like those 2. And again, like the iShares fund for healthcare, there's a spider that I like for this consumer staples play. It's XLP is the consumer staples ETF. It's got a bunch of other stocks if you want a basket, including retailers like Walmart. These are the core plays that consumers go out there, not discretionary expenses, but staples.
Right, and this is a way to actually sort of get a whole panoply of names under one roof, so to speak. I love the title of your next thing, and that is almost cash investments. Define an almost cash investment.
Well, I mean, putting cash under your mattress I don't really think is a wise idea. You got to get some type of return in there. But these quote-unquote high-yield savings accounts that got 1%, I mean, get out of town. That's not worth my money. So what you want to do is you want to have an investment that's almost as safe as cash, but gives you at least a decent amount of return so you can keep up with inflation. So one good investment that I think people should maybe look at is corporate bonds. The corporate bond market right now, you get yields of maybe 4 or 5%. That's not a huge amount, but it's a lot better than you're going to get in treasuries, a lot better than you're going to get in CDs. So I recommend investment grade bonds. There's a corporate bond fund from iShares. It's only investment grade bonds. The ticker symbol is LQD.
Beautiful, beautiful chart here. I mean, this looks great.
Yeah, and the reason that you see those returns is because these are names that people trust. There's Walmart in there. There's General Electric. There's AT&T. These are companies that are going to pay their bills. They're not going to default on their bonds. So almost as good as cash with those corporate bonds.
Almost
and the other investment
cash.
Other investment that I like, if you just want cash, but you want to worry about inflation, there's a lot of people worry about inflation with central bank policy. You can always go the TIPS route. Those are Treasury inflation protected securities. They're pegged to the consumer price index. They go up as inflation goes up too. So you're not going to get huge returns in those unless, of course, we see double-digit inflation. And frankly, you don't want that. But this is a great way to maintain your purchasing power. Again, the fund that I like is VTIP is the ticker symbol for that one. It's short-term securities, 5-year maturity or less. But again, if you think there's going to be inflation, you just want to maintain purchasing power, TIPS are a good way to do that.
Good to see you, Jeff. Thank you so much.
Protecting
your money against any kind of market stumble or implosion, because we showed the imploding building, so we got to say implosion. Good to see you, Jeff. Thank you.